Hi, I'm Jordan Bradford with Burkholder Wealth Management, and again here today with our CEO and founder, Eric Burkholder. We're going to do another video in our series on investment philosophy, and so today we're going to be talking about the size premium and whether or not that matters, and if we should be implementing size of companies into our portfolios. So I think I'll just go ahead and get started and just ask the question, but what is the size premium, Eric?
Yeah, so the size premium is the additional return that you get from investing in smaller companies measured by their market capitalization, which often also aligns with the physical size of the company and employees, revenue, that sort of thing. But it's really based on market capitalization. And when you look at the data, it's pretty robust over long periods of time. Small companies tend to perform better than large companies. And that's it in a nutshell. There's a lot more detail to it, but that is the size premium.
Yeah, and so if you watched our video on the value premium, I think the question that I would ask for that is, does this come up every year, or is it something that just is a pattern that we have noticed the trend on over time? I think the question I really have is, can we predict when the size premium is going to show up?
Right. So the answer is no. We do believe that over longer periods of time, we reliably expect it to exist.
Okay.
That's kind of a non-answer, but it comes down to statistics and data, right? And so it is robust, but just like the market. So, and just as a quick recap. Right, we talked about the different premiums we invest in here at Burkholder Wealth Management, all within, right now we're talking about the stock market side of things, but so the value premium, small cap premium, profitability premium are kind of the three big ones within each market. The reason why we look at those is because there is a lot of data over many time periods, over different markets that show that these appear. But much like the stock market, if you're going to ask me tomorrow are small cap companies going to do better than large companies, I have no idea. And really, when you go any day is basically a coin flip, right? But as you go out further and further in time, it becomes more reliable. Small cap premium is the least reliable or the least robust of the premiums, but still, we look at more like a 10-year time frame. 70% or more of those time periods, small cap companies do better.
Okay.
But that's also saying 30% of the time they don't.
Right.
So it's all about putting the odds in our client's favor, and therefore, we think they have a place in the portfolio.
And if it's the least robust of the three premiums that we are really looking to enhance in the portfolios, does that mean that small caps are going to come with more volatility?
Yeah, so they do. And there's different stories around why these premiums exist. Value is one that's unclear. Is it because it's a risk story, or is it an arbitrage opportunity? But I think with small companies it's pretty clear. They are riskier, they are more volatile, and you would expect to incentivize people to invest in those companies. There has to be a better return.
Right.
You wouldn't buy a smaller, riskier company unless you expected a higher rate of return. So it makes sense empirically and from an academic standpoint, but they are more volatile.
So how do we go about deciding which of the small companies we think are going to be the winners and which ones are the losers? Is there any metric that we have to help us maybe weed out some of the small companies that are highly risky but may not have that opportunity for growth that we're looking for?
Yeah, so in a broad sense, when we look at all small cap companies, there are some things we see, and that's that unprofitable companies within the small cap universe actually almost never outperform. You would think that that's just common sense, but that does not actually appear in other industries or in large cap companies, where especially the growth side of large companies, where unprofitable companies can actually do well for long periods of time. And so it's not just across the board. We are trying to fine tune that small cap company to really get a better risk return trade off there. Another thing I'll add, just kind of based on your question, is when we look at that small cap premium, oftentimes, as with other markets, but also in small cap, that premium may be totally captured within a few companies in a year. So you look at the entire universe of small cap companies in the U.S., and I don't know the exact percentage off the top of my head, but a vast majority, over 50% of that return, that excess return, may come from just a handful of companies in any given year. So our view would be we're not going to try to pick which one it's going to be. We know it's almost impossible to do that. We have to own essentially the entire investable market to make sure we capture that premium.
Right, and just excluding some of the companies that lack profitability.
Correct. Yeah, and because we have seen that those do not do well.
Yeah. So I think the next logical question I have in my head is, as small companies perform well, right? The idea is that they go from being a small company to a large company at some point.
Right.
And in a good portfolio, how do we as managers how do we deal with that when a company goes from being a small company to a large company? I think of examples like Tesla or Apple or Amazon, where at one point they were small companies growing really, really fast, and now they're extreme examples because they're not just large, they're behemoth.
Sure.
But what do we do about that, and how do we build that into our portfolios in a way where we're not then just owning a bunch of large companies 5 years from now?
Yeah, good question. I think an important point is in everything we look at, these investment principles have to exist, in academia, in a vacuum. But then we look at, are these investment principles, can we in practice implement them? And then how can we do that in an efficient way that makes our portfolios better? And so, for example, as you just said, small cap companies don't stay small forever, especially the ones that do well, the ones that we want to own. And so even within all of our portfolios, actually, but as opposed to an index, which just blindly picks, you'll often see the Vanguard small cap index, which is a great index, but we think it can do better because it will just say these are the small cap companies, and then once a year it will reconstitute and they'll change. So just that it's a set date, and it's not very there's thought into that date, but there's no kind of thinking through how could you make that a better process.
Yeah, so throughout the year then the small index isn't going to remove a company if midway through the year they're a large company. Right,
exactly. And you can run into, you don't really understand what you own, you don't understand the risk that's involved, and so the portfolios we use and we invest in, they do allow some momentum. That's another thing we can talk about another day. But so as these companies go, it's not a hard, as soon as they hit this size, they're gone.
Right.
We recognize that there's some momentum, but then they get sold as they go and move into that large space. So our investment in small companies stays small, and we can control that risk and return.
Yeah, I think you may have heard the term called style drift, right? That's what that's in reference to.
Right.
And I think that's a really important point in our portfolio management is that, you mentioned momentum. We'll talk a little bit more about that in another video. But we want to capture companies' growth when they're doing really well, but we don't want to hold on to those forever and wait for, the other shoe to drop, so to speak.
Right, exactly. There, especially in years like this when markets move quite a bit, your portfolio, what you think is the makeup of it, can change pretty dramatically if you're not investing in vehicles that are really monitoring that well.
Yeah.
I think another great story is GameStop, which we all remember GameStop from
the meme stocks.
A meme stock that exploded and at some point was in one of the small cap portfolios. You can imagine it immediately became a large cap. If there was an index fund out there, they have to wait until the following year to get that out of the small cap index. Our portfolios actually said, it's really rules based, but you can see something weird is going on. So it got sold.
Right.
And then if you remember what happened after that, it was a massive collapse. And so it doesn't always work out that well, but that's why you want to be smart about these portfolios and not just be static, for a year at a time. They should really be evolving and adjusting as the year goes.
Yeah, so it's kind of like, as portfolio managers, we're rebalancing throughout the year as the opportunities arise. And, the problems that can exist in an index are that oftentimes that rebalance date is just an arbitrary date set once per year. So if, a great example is March of 2020, when the market is down significantly in 1 month, there's different opportunities that are available to you as an investor than when the market is steadily moving.
Right.
Especially in a year like that, when the rebound was so quick. There were opportunities that were available at the end of March, early April, that if your rebalance date was just set arbitrarily in September, you missed out on any opportunity to take advantage of that.
Right.
And I think that we want the individual positions in our portfolio to really do the same thing and have that same effect. So I think that's a great way to kind of think about why we do it that way.
Right.
I think the last question I'd have is, if historically small cap companies do better than large cap companies, and we have pretty good confidence that over long periods of time that's true, why not invest everything in small cap companies?
Yeah. Good question. Maybe some people should, but I would say most people shouldn't. And part of it is recognizing there is uncertainty, there is volatility in the markets, and there are periods of time when they don't perform best. And so our job as portfolio managers, and especially connecting that to the end client, is try to build a portfolio using multiple premiums or factors and across different things, so we can smooth out that ride, and then just be able to not put a client in a situation when they underperform dramatically for a long period of time, which is really important, especially when they start taking money out.
Right.
It matters while they're saving, but also even more so when they're taking money out. So small cap stocks, we do think they will outperform, but we know, even on a 10-year time frame, that's 7 out of 10 times.
Yeah.
And so having multiple different things we can invest in, and then as you just mentioned, rebalance between, right? So if there is a period of time where small caps underperform, that probably means something else is outperforming. That can be sold and rebalanced into small caps. So you have all these different levers that are working together. As a whole, it's making a portfolio that's less risky and hopefully still hitting those return numbers. So, when anything we do, even if it's a factor that looks really good on paper, we don't know what's going to happen. And markets are uncertain, life's uncertain. So we're trying to diversify across multiple different factors.
Yeah.
If I knew exactly what was going to happen in the next 20 years, I would put 100% of our money in that, and I would be retired on a beach somewhere. So.
Yeah, that's right. That's what I always say. If I knew what was going to happen, I'd be on a beach. So
the last thing I would say about small companies and the small cap premium is, when we see like other portfolios and people come in and they're talking to us about their portfolio, it's very common they have value stocks in there. A lot of people
yeah, they love their Procter & Gamble,
all
Johnson &
those
Johnson
staples in the Dow that we see. They tend to have companies that screen profitability on the profitability factor. Those also are some of those names. A lot of the names that you see on TV. I often see portfolios with 0 to maybe 3% small cap exposure. Yeah. Oftentimes 0.
Right.
And so that's a portfolio that's completely missing out on a piece that can add diversification and return.
Yeah.
And so even though we just described, you got to be smart about how you implement it. They absolutely should be in portfolios, and people are really missing out by not having that piece.
Yeah, I think even if you're not trying to beat the market every single year, which many investors are not trying to do that. They're trying to save for retirement. They're trying to manage their wealth in a really prudent way. But even if you're not trying to beat the market, it's nice to have a sliver of your portfolio that, historically has been better than other parts of the market on long-term averages.
Right.
So I think, even if your goal is to just have a modest return, I think it's really beneficial to hold some piece in your portfolio that maybe is a little bit more volatile, but historically we can expect an outperformance at some point.
Absolutely. If you're 80 years old and retired, you still should have some small cap companies.
Yeah, just something.
Yeah, right. Exactly. So
awesome. Well, thanks so much, Eric, and I think this was some great information. We're going to have some additional investment philosophy videos coming out soon, so stay tuned for these amongst a number of other video topics we're going to be discussing with you here over the coming weeks, months, and years. So we appreciate you. If you have questions, reach out to us. We're here to help.
See ya.